Everybody thinks Bitcoin moves on a 4-year halving cycle. But what if I told you that model is dead? And the cycle is already breaking every rule we thought we knew about crypto. This isn't about hype, more so about structure. Since 2023, Wall Street capital, ETFs, and new legislation are stretching Bitcoin cycle into something modular, layered, and far more powerful. In this video, I'll break down the cycle extension thesis, show you where we are in the cycle, and why I think this cycle will peak longer and higher than anyone thought possible. Here's the proof. The 4-year halving cycle predicted Bitcoin top below 100K. And here we are sitting at $112,000 before retail had even entered the market. That's not 4-year halving cycle behavior. That is institutional driven liquidity. What we need to understand now about Bitcoin is that it can no longer be modeled like a commodity. We can no longer use linear pricing models to determine Bitcoin's price. Why? Because now that institutions are here, they're beginning to use Bitcoin as collateral to create credit. That becomes more of a money behavior. And now, as more and more people adopt the Bitcoin network, price modeling becomes exponential. Picture a linear trend versus an exponential trend. The latter breaks every perceived notion of price we could fathom. Previously, we've measured Bitcoin in block height, right? Once we get to a specific block height every 4 years, the halving kicks in. And when the halving kicks in, supply issuance is cut in half, which causes then the 4-year halving cycle to repeat. Once the supply is cut in half, capital flows back into Bitcoin because of scarcity and commodity-like metrics, all right? However, that is beginning to shift. Why is that? Now, because the liquidity pool has grown larger and larger since 2023 with institutions being onboarded into Bitcoin. So now, instead of block height, we need to look at liquidity. I'm not saying these 4-year halving cycles don't matter. Yes, supply issuance is a factor. However, it will become and is becoming no longer the driving force behind Bitcoin's price. We can see here in the image to the right of us, the beginning of the bull market highlighted in yellow. The second phase of liquidity highlighted in red. And then this is where everyone thought the 4-year halving cycle would stay true. A lot of people sold because of fear. That third wave was highlighted in blue. Around this time, we had a lot of people calling it's over, Bitcoin below 80,000, Bitcoin below 50,000, and so forth. However, they were wrong. They got caught offside. Why? Because institutional liquidity came in and price reversed. If liquidity is the main factor, well then what the hell can we look at besides Bitcoin price to help get a gauge on where and when price will likely move? At my fund, Palfrey Limited, we've developed this framework that quantifies liquidity into 3 regimes to easily help signify how much, how fast, and when liquidity will be present in the markets. And using that, you can adjust position and risk accordingly. Right here we have 2 of the most prominent phases that I believe we've been stuck in between this entire cycle. The first one is the fiscal slug, or fiscal plateau if you want to be more professional. Everything is kind of sluggish and stagnant in macro. In this case, Bitcoin would slowly grind higher, and we would see alt most likely bleed to death. That has been the case at some points in this cycle. And on the left here, we have the 10-year bond. And you can see it's been quite choppy for some time, and now it's being held permanently below that 4.5% mark. On the other hand, the giga bullish regime that we have for liquidity would be the reflationary ease. To see this reflationary ease come into play, rates come down, and the dollar, which we have here on the right, would continue to plummet. Now, earlier I said we were stuck between these two regimes. Look at the charts. On the left, the 10-year, kind of choppy, while on the right, the dollar got absolutely nuked in the first half of the year. What does this tell us? Liquidity is trying its hardest to freely flow around the globe. We've had China stimulate. Not too sure what Europe's doing. Canada's doing its own thing quietly behind the scenes to stimulate their economy as well. And meanwhile, the US is battling out between the chairman of their central bank. And what this means is that the liquidity that does find itself into the US, yes, it can seep into equities and the markets. However, a lot of that is going back to paying bondholders and also soaking up new issuance this year. So a lot of it can't really go to productive work inside the markets, like buying equities, like buying Bitcoin. It's going elsewhere. Another big factor of this liquidity extension is going to be the idea of fiscal dominance. So fiscal dominance refers to the fact that governments now will begin to demand central banks to maintain a certain policy stance in order for the government to help finance their deficits, which is why Trump and Besant and everyone on that party has been up Jerome Powell's ass all over the internet. Their debt has become the most important issue to manage. And what that usually means is spend more money. Here we have the chart to reference the big beautiful bill. Now that was passed earlier last month, and what that implied was a tremendous amount of spending over the course of the next 10 years in the trillions. However, 2 trillion of that has been front loaded into the next 12 to 18 months. Now we can see here the blue line would be the curve if that wasn't the case for the front loading of the 2 trillion, and the one above, the red, is reality. 2 trillion being front loaded, injected into the economy in the next 12 to 18 months, guys. That's why we can see the curve this year steepen. 2 trillion isn't just going to magically hit the markets. It's going to trickle through the economy, but that will have spillovers. With fiscal dominance at play here, and the government issuing this big, beautiful bill, front-loading $2 trillion of spending, needing to absorb copious amounts of issuance this year and into next year, what is going to happen to the dollar? We had mentioned one of the regimes that we map out at my fund is the reflationary ease, where the dollar nukes tremendously. All of these mechanics that this political party down in the States is looking to use to help manage its debt all boils down to the dollar getting weaker so they can stimulate their economy. If the dollar gets weaker and rates come down, yes, they can stimulate. However, inflation will be present. Bitcoin thrives tremendously under this regime. It's been doing pretty well so far. with the back and forth between the slug and the reflationary ease. However, once the full reflationary ease comes into play, I'm talking Q4 2025 into Q2 2026, Bitcoin will rip. Why? Because it is the only scarce sound money. And when the US dollar goes down, Bitcoin's price goes up. This is the chart I have laid out in front of us here. The white line is Bitcoin. The one behind that is the DXY, the dollar index. The US needs to stimulate. They need to depreciate the dollar. And you are not safe unless you hold Bitcoin, guys. All of this that I just presented, the fiscal dominance, the reflationary ease, the debt issuance that we briefly touched on, it all points to a longer cycle. It's been Chris from Coin and Capital. Hit that like button if you enjoyed. Drop a comment if you learned something. Drop a comment if you have any questions. I would love to chat with you guys. And as always, make sure to hit that subscribe button. I'm trying to build an audience here to help educate you guys on everything Bitcoin, everything finance. And I will see you guys in the next video.